Seminar 2. The accounting equation for public companies. Assets equals liabilities plus stockholders' equity plus paid-in capital minus dividends or treasury repurchases treasury stock plus revenue minus expenses. Now that's for a public company, because for public companies you have shareholders who buy shares of stock. For a non-public company such as a sole proprietor or a partnership, it's a more basic of an equation. It's assets equals liabilities plus stockholders' equity minus owner's drawing plus revenues minus expenses. There's 4 basic financial statements. The first one is the income statement. That's revenue minus expenses equals your net income. Revenue is fees earned from providing services or products sold. Examples would be sales, service revenues, fees earned, interest revenue, interest income. Expenses is the cost of doing business or the reduction in the value of an asset as it's used to generate revenue. And that would be things like wage expenses, utility expense, rent expense, and fuel expense. The balance sheet is assets equals liabilities plus stockholders' equity. That equation means that assets equals the liabilities and the stockholders' equity together. So I could look at this equation in another way. I could say assets minus liabilities gives me my stockholders' equity, or assets minus my stockholder equity is going to give me the liabilities. So assets are any item of economic value that can be converted to cash. It has a future value. That would be things like cash, accounts receivable, office equipment, inventory, supplies, buildings, land, and vehicles. Liabilities are debts and obligations of the business they represent as creditors' claim on business assets. Liability, you know what a liability is. If you have a house payment or a car payment, it's things we owe. If it has the word payable in it, it's a liability. Examples would be like a mortgage, notes payable, and accounts payable. Stockholders' equity represents the interest of a company's shareholders in the net assets of the company. It equals the excess of a company's total assets over its liabilities. Examples would be retained earnings, common stock, and paid-in capital. The statement of owner's equity is a detailed explanation of the capital received from investors in exchange for stock, and paid-in capital, donated capital, and retained earnings. Stockholders' equity represents the equity stock shares currently held on the books by a firm's equity investors. It is calculated either as a firm's total assets minus its total liabilities, or as a share capital plus retained earnings minus treasury shares. Treasury shares are shares that the company had issued and then turned around and bought back or repurchased. So the fourth statement is the statement of cash flows, and I have this video is going to be broken down into 3 parts because it was so large. Don't let that scare you though. But I have another section of a statement of cash flows, and there's going to be an assessment question, but you might want to watch the other video to answer one of the questions about statement of cash flows. Either or, it doesn't matter. I think both will give you enough information to answer the question. So statement of cash flows represents the cash generated and used. It is the cash receipts and the cash receipts in and the cash receipts out. There's 3 categories. It's operating activities, cash provided and used in normal operating activities such as current assets, accounts receivable, and current liabilities, accounts payable. Those are just examples. That's not limited to just that. That was just an example. So investing activities is purchases of long-term assets such as property, plant, and equipment. And financing activities includes purchases of bonds and stocks and dividends paid. So the basics of accounting is called a double entry system. This means that debits equal credits. Accounts with debit balances, there's 3 account titles. They include assets, expenses, and owner's drawings or dividends. Accounts with credit balances, there's 3 of those. It's liability, stockholders' equity, and revenue. The normal balance refers to the side that is increased. So I drew a little picture here, and if you see the arrows going up, so I've got what we call in accounting a T account. My debits is always on the left, credits are always on the right. Always, always, always. It never changes. Do not associate debits and credits with anything to do with banking. It's two different, very different things. It will confuse you if you try to make the comparison. So just think of this as new material coming in. Debit in accounting are assets owners drawing or dividends paid and expenses. The normal balance is a debit. That means that anything I receive, if I receive an asset, if I receive cash, it increases my cash. Normal balance is an asset. But if I pay a bill with cash, I'm reducing my cash. It's going out the door, so it becomes the opposite. Now it becomes the credit because I'm not increasing it, I'm decreasing it. I know that's kind of confusing. So for example, a liability. If I create a liability, if I put something on accounts payable, I'm increasing my accounts payable because I'm adding to it. So in effect, what I'm doing is I'm increasing it. So the normal balance of a liability is a credit. So when I increase it, I credit it. However, if I was to decrease it by paying it down, I would make it a debit. Okay. Here's your questions. Assessment question 1. What financial statement contains assets, liabilities, stockholders' equity? Which financial statement contains revenues and expenses? C. Liabilities plus stockholders equal what? And briefly explain the cash flow statement. I'm not looking for 2 or 3 pages on this. I'm just looking for a paragraph. And I want you to get 3 different categories of what is included in a statement of or cash flow statement, and kind of briefly explain what those are. Okay, this is the end of the first video. We have 2 more to go.